Hey guys, it's Neil Tipton with Waterstone Mortgage, and I'd like to address a concern I think a lot of potential homebuyers have, whether consciously or subconsciously. The memory of 2008 and the impact it had on homeowners and their families is still fresh in our minds, and many are wondering if the housing market's going to face another major reckoning. And I get it. At first glance, we're seeing some of the same things that led up to a really difficult time. Home prices are on average almost 40% higher than before the pandemic. Mortgage rates have more than doubled since the start of the year, thereby reducing purchasing power. And lower affordability suggests that some home purchases may be deferred, while some buyers are just going to have to settle for less. But that's where the similarities stop. And there are really four key reasons that suggest the bottom will not fall out. First, demand for housing is constant. While consumer sentiment surveys suggest many believe it's a bad time to buy, what consumers say and what they do is often very different. While demand may decline some, it will not be erased. Life changes still necessitate home buying. And with high occupancy rates and rising rents, rentals aren't an attractive alternative. Second, a repeat of the global financial crisis is unlikely. To improve affordability, increasing the availability of credit by loosening underwriting standards is likely to happen. However, we're not going to see a return of the products that helped create the housing crisis, such as pay option ARMs and stated income products. Third, tight supply will largely offset any decline in demand. Home sale volumes are likely to fall substantially, a trend we're currently experiencing, but we expect the effect that declining demand has on home prices to be partially mitigated by tight supply. While it may ease in the near term, estimates indicate a shortage of 3 to 7 million homes nationally, and new home building is insufficient to close this gap quickly. Another factor expected to weigh on supply is the lock-in effect. The average homeowner's mortgage rate is almost 2.5% below prevailing rates, discouraging those hoping to move. Fourth, existing borrowers are in a really strong condition. While the situation for house hunters is challenging, existing borrowers are generally in fantastic shape. Unlike during pre-global financial crisis conditions, over 90% of borrowers have fixed rates. About 2/3 of the mortgage market has turned over since the start of the pandemic, with some of the tightest and most conservative underwriting standards in history, as well as some of the lowest interest rates. In addition, existing homeowners generally have significant equity in their homes. This means a spike in the supply from bank foreclosures is unlikely. In conclusion, supply and demand drive the housing market, and affordability is critical for new and existing home buyers. That said, as a result of these supportive supply and borrower credit factors, history will not repeat itself. While it's unknown if the economy will have a hard or a soft landing, supply and demand dynamics will most likely result in a flat to moderate home price appreciation, with modest home price depreciation a possible scenario in the event of a recession. Even then, time horizons for considering a home purchase should be more than just a couple years. Over a long enough investment window, real estate prices always go up. That's why the median net worth of homeowners is a whopping 80 times that of renters. So call us today to start the pre-approval process and start your journey to homeownership. Thanks for watching.